Great questions.
We are about 22 seconds away from the opening bell. Let's get you some price action briefly in the equity market. Equities right now down a third of 1% on the S&P. On the Nasdaq, which has been absolutely flying year to date and over the last week, was softer there, negative by 0.5%. The opening bell in New York City rings. Switch up the board and get to the bond market. Yields look like this going into a pivotal week potentially for the Federal Reserve. Going into that, yields just a little bit higher, up 5 basis points on a 10-year to 354.22. Dollar showing some strength, euro some weakness. Euro dollar down 0.4%, a break of 109 again at 108.50. And looking elsewhere at what's happening with crude, WTI $82 and about 15 cents, positive there 1.4%. We are about 20 seconds into this. Equities are lower by 0.25% on the S&P. On the Nasdaq down by a third of 1%. One stock to watch at the open, it's Intel getting absolutely hammered. The chip maker reporting misses across the board and issuing a pretty grim outlook. The CEO saying this: given the continued uncertainty, we expect PC consumption to be on the lower end of our estimates this year. That stock hammered on the West Coast. Here's Ed Ludlow.
Good morning, Jonathan. The stock down 10%, a significant drop. And what was so interesting in the sell side response is that even against extremely low expectations for the first quarter forecast, this was a surprise and an astonishing forecast from Intel. Let's get straight into the numbers. A forecast for adjusted sales, $10.5 billion to $11.5 billion in the first quarter. But even at the top end of that range, you're still $2.5 billion below the consensus estimate. A surprise forecast for an adjusted loss of 15 cents a share. The street was looking for modest EPS of 25 cents, but we point out in the Bloomberg story that on an adjusted basis at least, this is the first prediction of a loss in a quarter that Intel has made in decades. The story in its end markets, Jonathan, is very clear. Look at PC and desktop demand, look at data center. Both account for almost 80% of revenue, both dropping year on year more than 30% in terms of that quarterly revenue change year on year. The message from management is bear with us. Of course it is. Look at how Intel shares have performed since 2021 when Pat Gelsinger returned to the company and took over as CEO. At that time, it was the top chip stock. It's lost its crown since then to Nvidia, but they look like there are no signs of that ever coming back. And Gelsinger on the call, John, made a pretty clear point. I'd like to remind everyone that we're on this multi-year journey. We're more than a year into the multi-year journey. I guess the question for the street is how much patience have you got for that journey?
Maybe not much based on this morning's price action. Ed, thank you for that. Intel down by 10 percentage points. We've seen some bad tech earnings so far this earnings season, but tech, the Nasdaq, if that's how you capture tech, has performed tremendously well. We are only down about 0.2% right now, and year to date we're up about 10 full percentage points. Michael Hartnett over at Bank of America published this morning. Here's a quote for you. This year tech has been playing catch up. Rate cuts, dollar down, job cuts for margin. Speculation has returned. He calls it the pain trade. The pain trade has been higher to 4.1 to 4.2K on the S&P 500. Right now, 40.53 on the S&P. He goes on to say, after that, after you get through 4,200, after that we sell, as we now are close to the moment where stock gains start dragging yields higher. That from Hartnett this morning, something to think about anyway. Here's another name for you. Amex painting a very different picture to Intel. The firm forecasting a surge in revenue after record card spending. The CEO saying it's, quote, in an even stronger position today than before the pandemic. This as competitors saw slower than expected spending in the last quarter. Let's get to Abby for more. Hey, Abby.
Hey, John. Yeah, this is an interesting one. And as you mentioned, the stock is surging its best day in about a year. This after that record spending last year. Now, interestingly, the quarter that was a little bit messy on the surface, but that outlook, it's all about the outlook, the fact that consumers are spending so much, the idea that they were able to boost their ranges for pretty much all metrics in a big way. Relative to earnings, they're looking at a range of $11 to $11.40 for this year versus the estimate of $10.43. They're looking for revenues to rise 15 to 17% versus the 11% growth estimate. So really all systems a go. Now, it has to do with that consumer spending it's really interesting because during the pandemic, at the beginning of the pandemic, we saw credit card spending really plunge to less than $1 trillion. Now we're at a record high, closer to $1.2 trillion. It seems as though with the inflationary picture, some folks have also been using credit cards for essential needs, not just the nice to haves. Now, relative to the recent rally, we have the credit card company stocks doing really quite well, up as much as 11% into the open. I'm guessing that American Express up much more. There you go. Well, up right about 11%, taking that spike, outperforming the financials overall. Now, American Express, John, is a part of the financials, but Visa and MasterCard, those stocks up close to about 10%. They are actually a part of the technology group, so there's another piece of that tech rally that we can't get away from this year.
Abby, thank you. Amex up by 7.4% this morning. Abby, thanks for that. Chevron is down by 2.75%. It's a miss for the oil major. Disappointing fourth quarter results coming just days after announcing a monster buyback program. Here's Katie Lyons with more. Hey, Katie.
Yeah, so John, this loss of nearly 3% at the opening bell this morning is giving back some of the gains that were made yesterday when the stock rallied nearly 5% after that $75 billion buyback announcement. So a little bit of that optimism from Thursday is not filtering through to this Friday on that disappointment. Revenue did come in ahead of expectations, but net income came in light and profit of $4.09 a share fell short of the estimate. Now, part of that is just the fact that oil prices have come down, but another part too, according to analysts over at RBC Capital Markets, and we'll have to excuse the fire alarm going off here in the U.S. John, hopefully you're not hearing that in London, but you have corporate costs as a factor here, and the outlook came in light as well. I would just note, and I'm going to wrap it up because this is really loud over here, Chevron did have a record year of profit in 2022, and we know, of course, that has drawn political ire. They would like to see them investing more in output, not buybacks, but we know Chevron is trying to do both, John.
I'm hoping this is a drill, but you should probably run. Katie Lyons, thank you. Only Katie could remain that calm in the face of a fire alarm going off. I assume that's a drill, and hopefully for Katie's safety, it is one, and I'll confirm it is one in a couple of minutes' time. Equities right now down 0.2% on the S&P 500. We are about 6 minutes into the session. The Nasdaq is negative by 0.15%. RBC's Amy Wu Silverman seeing a shift in investor behavior and writing the following: we came into 2023 underhedged, underinvested. We're starting to see this change somewhat, seeing renewed demand for downside protection. Amy, I'm pleased to say, joins us right now. Amy, great to catch up with you. You said in your notes that you've published recently that this is the boy that cried wolf market. Can you tell us all what you mean by that?
Sure. Good morning. So, look, when you look to last year, the S&P drew down 20%, and the only option strategy that did worse was if you owned the S&P and owned puts, you managed to be down 21%. So, it was pretty unlucky for investors who wanted to hedge, got the drawdown, and still managed to lose more money. And so people were burned. They didn't want to listen to any of the metrics coming up. And I think that's why we ended up in 2023 with the positioning that we saw. So I find it very interesting now, John, that we are finally starting to see this uptick in demand for downside protection that we didn't see at all during the drawdown last quarter, and we finally started to see that change.
So, Amy, you're saying investors are using this recent strength to reload on downside protection, and if they are, what are you advocating they should do?
Yeah, I would say two things. One more sanguine interpretation is that part of the reason we finally see this demand, John, is because people are actually becoming more invested in the market. So, there's only something to hedge when you've actually managed to make that money. The second thing I would say, as you start to get that uptick in skew, the options curve starts to structure in such a way that things like put spreads, which you and I have talked about before, look attractive based on their payouts. So, ahead of what is quite a monster week, both individually for stocks as well as for macro, and a VIX kind of sub 20, I think those trades look attractive.
Amy, can we talk about next week just quickly? How much of a risk event do you think that Fed decision actually is?
So, I think it's interesting because with PCE coming out as it did today, maybe that takes some relief into the market. But, to me, more importantly than even what the Fed will say is just the slew of tech earnings we're going to get. Because, if you continue to look at what the meat is made out of in the S&P and other ETFs, it's still, a handful of names, a handful of mega cap tech names. And sure, there was shrinkage in 2022, but if you look at that contribution return, John, from last year of that 20% drawdown, it kind of came down to 80% being, again, 7 to 8 mega cap tech names.
The longer this goes on, the more it hurts with this rally in mega cap tech, and the Nasdaq has been rip-roaring year to date. Amy, what are you telling your clients about it?
Yeah, I think one thing to keep in mind, and I was watching that Intel print as well, is, historically options can kind of tell you what the implied move is on earnings, but usually options don't actually beat their implied moves. The realized move on earnings, they tend to be lower. This has been the opposite really during the pandemic period. So, one name I would point to is Meta, which if you look on an 8-quarter basis, which is what most people do, it kind of looks like a fair implied move to earnings. But on a 4-quarter basis, this is a stock that realizes an 18% move in either direction on earnings, and it's only pricing in a 10% move right now. What does that mean? I think you own all implied moves by owning options. So, that can be to the upside or downside based on how your portfolio is framed. But right now, actually owning options pays far more during earnings season than it has in many past earnings seasons.
So we've addressed Fed, we've addressed tech earnings. Can we address China just briefly? This is one of these issues, and you've published on this, and it's important to recognize it's one of these issues that actually provides us with upside risk. And Amy, I'm wondering how you're telling people how they should gain exposure and participate in the potential that upside risk really develops even further.
Yeah, it's interesting. I'll tell you one thing. This is an area where the options market was quite early. We saw folks buying upside in ASHR, Web, Baidu, FXI, months before the reopening. And every time I spoke to clients, they said, look, am I going to get burned? Is this a premium going to zero because China hasn't reopened yet? Maybe, but I have to participate. One thing I'll say is that's inflecting. We're actually seeing defensive positioning now. But two, for people who still want participation in China, I would actually focus on cheaper ETFs, maybe an EEM or single name Chinese ETFs like a Baidu, where that relative volatility hasn't priced in as much as something sort of more obvious like a FXI.
Amy, do you think the range of outcomes in the China story are wider than people give it credit for?
I do, and I've spoken to some folks where, they were kind of long earlier, and now the inflection point has gone to more defensive. And, my question has been, what do you think is going to happen? It looks like, we're kind of full blast on reopening. And the risk people point to, the left tail risk is that if you look to the reopening that happened in the US or Canada, it wasn't linear, John. It wasn't like, okay, we reopened, the end. There were fits and starts. There were different variants that came up. There were kind of waves of lockdowns. And that's the concern right now, which is why I think, given how far we've run, some people are starting to get concerned.
We've run a long distance already, and I think we're only 3-4 weeks into this. Amy, this was wonderful as always. Amy with Silverman there, looking ahead to next week and beyond, in the case of China at least. We're about 12 minutes into the session. Equities are down by 0.2% on the S&P. On the Nasdaq, we're lower by 0.15%. That's the session. Year to date, equity markets have been absolutely flying, from the Nasdaq 100 all the way over to the Euro Stoxx 50, EM and China for that matter as well. Year to date, the numbers have been absolutely phenomenal. I mentioned Michael Hartnett of Bank of America, and when Michael publishes his weekly flow data note, he puts in there, heard on the street, and just a quote from a client or something like that. And this was the quote this week. I'll read it to you. Another 3 to 5% here will feel like bathing in lava if you're a bear. This is painful for a lot of people the last few weeks, that's for sure. Equities right now then 12 or 13 minutes in, we're down about 0.1%. Coming up, the Fed and ECB releasing decisions next week after striking a hawkish tone back in December.
We continue to anticipate that ongoing increases will be appropriate.
We judge that interest rates will still have to rise significantly at a steady pace.
That conversation up next.
The full effects of our rapid tightening so far are yet to be felt.
More needs to be done.
Ongoing increases will be appropriate.
Risks stem primarily from domestic factors, inflationary pressures,
Inflation remains well above our longer-run goal.
the 2% inflation target,
I wouldn't see us considering rate cuts
for a period of time.
until the committee is confident that inflation is moving down.
Interest rates, we still have to rise significantly.
There are not rate cuts in the SEP for 2023.
That was the message in December, a recent deluge of economic data and better than expected data, now setting the stage for both the Fed and ECB next week. Those rate decisions front-running the US payrolls report on Friday. Team coverage begins right now with Bloomberg's Mike McKee in New York and Guy Johnson over in London. First to you, Mike, your thoughts on this Federal Reserve next week and what we need to look for.
Well, I think the numbers that we got today, and excuse us, there's a bit of a fire alarm going on in the background here. Numbers we got today on inflation make it fairly certain the Fed can do 25 basis points. The PCE inflation numbers that they follow closely went down on a year-over-year basis. And so at this point, it looks like the Fed can do 25. The question is what happens when we get into January, and do those figures suggest the Fed has to start doing more again? But right now, it looks reasonably good.
Chaos in the New York studio, Mike McKee. I'm not sure if you've got a run to be in this fire drill either. Mike McKee there, over in New York. No one seems to have a clue. Guy Johnson with us here in London where there are no fire alarms, guys. So we're good, I hope. The ECB, it took me by surprise in December just to see ECB President Christine Lagarde as hawkish as she was. I think the most hawkish you and I have ever seen her.
Yep, and it's continued. That's the message. It has continued through January. We heard it at Davos as well. The World Economic Forum message was very hawkish. The message coming consistently from most members of the ECB is that we will see a 50 basis point hike at the next meeting. There are a few exceptions. The real question, John, is not what happens at this meeting that's upcoming. It's the signalling for the next meeting and the meeting after that I think everybody's going to be watching out for.
The Doves are trying to be heard. I imagine there's some real division on that committee now.
Yeah, but the balance is firmly in favour of the Hawks, and the Doves are going to struggle. There was a long period of time when the Hawks weren't heard. We've completely flipped that on its head now. There aren't that many Doves out there either. Clearly the Portuguese, the Spanish to a certain extent, the Italians and the Greeks. But the amazing thing is that BTP spreads are being well behaved. And in some ways,
I'm surprised.
I think a lot of people are, and that is in some ways giving the green light to the ECB to do more. The market is signaling that it's comfortable with what is being priced in right now, and it opens up the possibility of further signaling as well when it comes to QT.
I keep saying this, I was shocked that we managed to get to 250 at the ECB without absolute chaos in markets, and now people are talking up, 350?
Yeah,
More so?
I think that's being seen as being kind of where the market is. I think that is the expectation. Whether we get that far remains to be seen, because when things change, they change fairly quickly. We'll wait and see whether or not that ultimately is the destination. I do think, though, that while the destination is increasingly important, what we haven't had from the ECB is all of the details on QT. And I think that's kind of where I think the focus may become.
Let's talk about the destination for the year ahead for Europe. I spent the week here, Guy. You've heard the same voices tell you the same things, which is that the ECB can hike more than the Federal Reserve this year, just in terms of the additional rate hikes. Maybe they don't get to 450. Who knows? I'm struck by the war in Ukraine still continues.
Yep.
I'm struck by the fact that it looks like it's escalating based on the fact that tanks are now going to be arriving in Ukraine in the next several months, and there's a conversation about maybe jets following. I have no idea where we are on that. I spoke to Henri de Sen earlier this morning of Energy Aspects about whether Europe could repeat the act that it managed to perform in the last 6 months, which was build up storage levels, build up capacity, build up gas storage, preparing for winter. Can they repeat the act for next winter? And she said she doubts it. No.
It's interesting because a lot of people do think that is now possible. They think that Europe is going to be coming out of this winter with significantly higher storage levels than is normally what would be seen. In some ways as well, it's about price. This is not a supply shock for Europe, it is a terms of trade shock. It is about how much you have to pay for the gas, and I think that is the critical difference here as well. It does come back down to China. What happens with China and its demand is going to be crucial in terms of what happens here. The weather, as we all know, is going to be critical. The big surprise this year has been around the weather. It's been Mother Nature that has provided the biggest surprise here.
Sure. Throw in a bit of coal as well.
Okay, throw in a bit of of coal as well. That was already kind of there and ready to go. The fact that we've had to use it maybe less than anticipated, I think, is probably the bigger shock. And I think you've had a really interesting story this year. Can it be repeated next year? I don't know. Give me a long-range weather forecast and I'll probably be able to tell you.
Yeah, I'm not a meteorologist. I'm not sure a meteorologist is any good at that either.
No.
Guy, this was great. Am I seeing you in the States next week?
Yeah, I'm going to look forward to seeing you in the States. I've got to go via Seattle to the handover of the last 747
emotional.
on Tuesday.
Emotional.
Oh, yeah.
For you, not so emotional for me. Guy, I'm looking forward to the conversation note. Great interview coming up next week. Look out for that. Guy Johnson's going to be with us stateside. I'll be there as well with Michael McKee, counting you down to that Fed decision. I can confirm that there wasn't a real fire. It was somewhat of a drill, if you want to call it that. Okay, about 22 minutes into the session, equities positive now. On the S&P by a tenth, on the Nasdaq by a third. Let's get you some sector price action. Here's Abby.
Hey, John, and yes, much quieter here, although there was a moment where we wondered. At this point, we do have the S&P 500 up slightly, up almost about 0.2%. Most sectors are higher for the S&P 500, led by consumer discretionary, up about 1%, communication services right behind. So we also have technology higher. Those mega cap packs once again leading the way. To the downside, we have energy, despite the fact that oil is higher, healthcare, utilities, and staples. So those defensive sectors, with the exception of energy, those are the ones on the downside. Now, we do also have stocks higher on the week. Surprise, surprise, up more than 2% relative to the sectors. Despite the fact that we have this Intel debacle, we actually have the stocks higher. We have the discretionary space higher on Tesla. To the downside, though, John, there are those defensive sectors. We really have investors going into growth quite strongly this year.
Avi, thank you. Up next on the program, your trading diary. Equity markets turning around here about 25 minutes into the session. We're positive a tenth on the S&P, on the Nasdaq up a third. Let's get you the trading diary. UMich sentiment survey coming up at the top of the hour. Looking ahead to a monster week, a Fed decision and Chair Powell news conference on Wednesday, followed by earnings from Meta, rate decisions from the ECB and BOE on Thursday, plus results from Apple, Google and Amazon. And finally, it's Jobs Day in America to round out the week. Here is your week on this program next week. What a monster lineup that the team has put together for you. On Fed Day, Kathy Jones, Bob Michael, Chris Harvey, Mike Wilson. That's on Fed Decision Day. On Payrolls Friday, Mohamed Al-Arian, Rick Reeder, Anastasia Amoroso, Mike Collins. All of that coming up next week. Live from London, thank you very much for choosing Bloomberg TV. I'll be back with you in New York next week. This was the Countdown to the Open. Have a wonderful weekend. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes to the U.S. Trading Day, Friday, January 27th. Here are the top market stories we are following for you at this hour. Downshifting inflation, downshifting Fed. Price pressures ease, spending slows, paving the way for a 25 basis point hike from the Fed. And Amex is in your wallet. Investors like the credit card company's 2023 outlook and dividend boost. You're looking at a stock up by a whopping 10%. We're going to get the read from Visa with CFO Vasant Prabhu. And Intel clouds tech. The company gives a horrible forecast. Shares slam. We try to figure out the problem is Intel, chips, or the macro. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets, Guy. And speaking of macro, we still get some coming in here, but I do think that the Intel read is going to be quite interesting, particularly when you're looking at a pretty resilient, at this point, NASDAQ 100 and stock move.
Yeah, it's interesting. Maybe this is being taken as idiosyncratic to Intel. There is a little bit of a bleed across into some of the other chip stocks, but we'll talk about that in just a moment, try and get a read on what is happening here. We're getting some pending home sales data. Looks better than anticipated. 2.5, that's a positive number. The market was looking for -1. That's much better than the -4 we got last time round, which has actually been revised up to -2.6. The UMich data, a little bit better, you could argue, I guess. The inflation numbers, let's look at those. That's what we all focus on. The one-year inflation number actually revised a little lower to 3.9. The 5 to 10 revised down to 2.9. So, I don't know, what do you think? That number looks a bit better. In fact, all of that data looks a little bit better and maybe signals that soft landing we've been talking about. Yeah, so you got soft landing conversation coming. The hard data still holding up relatively well. Earnings, though, it feels like is very much clouding the macro picture. Absolutely. So that'll lead us perfectly into our conversation around Intel. Let's break down these numbers and pull in all the PCE data that we've learned about today. Mike McKee, as ever, joining us on set to discuss all of this. Mike, walk us through the numbers we've got today. Do they in any way change the picture?
They don't change the picture, Guy. They make the Fed feel a little bit better about what it's thinking of doing right now. We did see that personal income rose 0.2%, but a 0.3 rise in wages and salaries, which is lower than it had been. November also revised down. So the wage fears the Fed have may be starting to moderate a little bit. And then the inflation numbers for December were reasonably good, up a little more than anticipated on a month-over-month basis, but down from the prior month. And on a year-over-year basis, we have the headline number that they look at 5%, down from 5.5%. And so making progress in that area. However, these are backward-looking numbers. And you take a look at this here, it's kind of interesting. This is the personal consumption, which was down 0.2 this month. It was also down in November and up in October. The last three lines there, that's the fourth quarter. And so as the fourth quarter went on, two things were happening. People were spending less, but you look at the white lines, so that's the savings rate. People were saving more. So I'm wondering if, in a way, what people were seeing in terms of and saying in terms of the Michigan confidence numbers last month are reflected in their behavior. They were more concerned about the direction of the economy then, and so they started saving more money and spending a little less money. Now that the numbers have turned up, is that a sign that people are going to be spending a bit more? Well, that's what I was going to wonder. So does this mean that, oh, okay, actually the data's not that bad. I'm going to go spend it, or I'm going to keep saving it because the back half could still be really lumpy and I'm seeing all these job cuts? I really wonder then the psychology. I'm not spending. Yeah. I'm saving. You're saving? Well, yeah, we believe that. No. Right, Guy? No. Yeah, I'm with you. The Michigan, not just Michigan, but all the confidence numbers the Fed looks at as contemporaneous. They tell you sort of what people are thinking right now, but they don't really give you a good idea of what's going to happen next, because look at how the numbers have turned around over the last month. But there is that possibility out there that people are still concerned down the road. Now, you look at the Michigan expectations number, it rises 62.7, still low, but it is rising, so maybe people are feeling a little bit better. And what's going to happen is the data feed into this, the stock market feeds into this, lower inflation feeds into people feeling better. Now, if Alex lets gas prices go up, then people are going to be upset again.
Yeah, I guess I get to tax season, and maybe I'll start spending again. All right, guys, thanks a lot. Michael, thank you very much. I appreciate it. Michael McKee. All right, meanwhile, we're taking a look at Intel. Shares are just pretty terrible. You're looking at one point, the biggest drop since 2021 in October. They gave a really grim forecast. So our question of the day then is, what's the Intel on chips? Is this an Intel story? Is this a chip story? Cyclical story, or is it a macro story? Joining us now, Bloomberg Intelligence Senior Technology Analyst Mandeep Singh, along with Bloomberg Technology co-host Ed Ludlow. Mandeep, what's your take on the question?
Well, so I think PC market is in a really bad shape, and because Intel is the largest player, and you saw them talk about bloated inventory, and they haven't called the bottom yet, and they think it's going to progressively get worse. So I think it's just a very divergent characteristic when you compare PCs to data center and autos, where the chip makers are doing very well. There isn't a bloated inventory situation. So really, PC as well as execution on the data center side, because that's where Intel continues to lose share to AMD and NVIDIA.
So Ed, is this an Intel issue, a market issue, or a macro issue?
All three. I mean, there is evidence clearly that Intel's suffering from an ongoing loss of market share to rivals. This is a continuation of a story that Pat Gelsinger is trying to turn around, right, since he came back to Intel in 2021. To Mandeep's point, right, that you have to look at the commentary on the two key markets, which is PC or desktop and servers account for 78% of this business. Both are forecast to drop year on year by more than 30% on the top line. And as Bernstein analysts put it, right, these forecasts were astonishingly bad, even against what were very low expectations from the street. It's been decades since Intel has forecast a quarterly loss, and yet we go into the first quarter of Intel saying that adjusted EPS will be negative 15 cents. The commentary was that in the first half of the year, PC shipments and servers do not improve. They continue to deteriorate with volatility.
But Ed, I have to say, other chip stocks were getting hit hard, and now they're clawing back. Like Qualcomm's at neutral here, AMD is actually up. And I do have to wonder, how do you play, though, the idiosyncratic part of Intel as they transition? Who's stealing their market share?
Yeah, I mean, the market share question is hard to quantify, right? Because we're going on quarterly earnings that are backward looking. AMD has made inroads right into that server business, and I think that, the main piece of reporting that I point you to on the Bloomberg is go to Ian King's bio and look at the new product launches that have happened, not necessarily in the last quarter, but the last 2 years. Others have continued to innovate in this space. Intel has been much slower, right? And the message from Pat Gelsinger is this is a multi-year project to return Intel to its kind of former glory. The question is, how much patience do investors have? But also, when is Intel going to do something innovative that will actually kind of claw back that market share erosion?
Mandeep, to Ed's point, we clearly need something from Intel to act as a catalyst to get the stock going, to get the company going. But is this what we would have expected? When we first talked about this idea that Intel was going to go through a multi-year reorganization, that it was going to reshore, that it was going to change its approach, when you were thinking at that point there'll be a low point, is this what it would have looked like?
I would guess so, given the demand weakness we are seeing on the PC side. And look, PC replacement cycle will play out. You will see a rebound. It's a cyclical market. But what Intel has to figure out is how do they scale the Mobileye unit into a broader manufacturing kind of base where they can manufacture more auto chips, for example, for other car makers. And I think those are the kind of drivers they need to find out, as well as getting that government support, which they have from the U.S., from EU, in terms of getting the supply chains back to the U.S. They have the fab capacity. There's no one else out there who has the fab capacity that Intel has in terms of manufacturing chips at that scale.
Hey, Mandeep, based on where we are in the cycle, where are we in the chip cycle? And is this going to look a little bit different than normal?
Well, so I think you bring up a great point, Alex, that maybe PCs are leading, a downturn in server capex as server chips as well as auto chips. And even though those guys are doing fine, there will be a period in the second half where there will be a downturn, for example, and a bloated inventory situation for auto chips. Again, it depends on what kind of recession we have, what kind of soft landing we had, but maybe PCs are leading that, and those risks aren't priced in yet, at least in terms of the estimates.
You've got to assume that there has to have been a lag from the pandemic. Like at some point, we all had new laptops, we all had new kit, and you do wonder, to your point, Mandeep, are we just working our way through PCs? We had a lot of those. Then we had issues with cars. We're working our way through that. This is just a kind of sequential process. Mandeep Singh, Bloomberg Intelligence, Bloomberg's Ed Ludlow. Guys, thank you very much indeed. Perfect. Alex?
All right, coming up, we're going to get more on the question of the day, right? So what's the intel on chips? We got the cyclicality of it, so now let's get the macro signal. Megan Hornman of Verdence Capital Advisors joins us next. This is Bloomberg.
Earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money with exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
It's quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
If you look at equities, we're sort of middle of the road, but think about the opportunities, the valuations that really needed to come down. It's in software, it's in tech, it's in venture, and we have started to see a pretty meaningful reset there.
That was Anastasia Amoroso, Chief Investment Strategist at iCapital, weighing on those falling tech valuations. And then takes us to the question of the day, what's the intel on chips? I should point out the NASDAQ 100 is now up 0.5%. Joining us now is Megan Hornman of Verdence Capital Advisors, CIO. Megan, great to see you. So I understand, I know you can't talk specifically about intel, but is there a macro read or just a chip read that you take away?
I think it's a macro read, and I think you'll hear this echoed as earnings season goes on. We have a lot more to go within earnings season, but I think you're going to hear a lot more of this from just the overall economic slowdown that they're seeing, and they're going to come through and push that guidance lower for the rest of the year. It needs to happen. Earnings have been very slow to come down for 2023, so I think you're going to see a lot of companies do that with that fourth quarter earnings season.
Megan, equities had a great run into the earnings season, though. Is the earnings season going to be enough to unwind that run?
Well, remember, January also can be a seasonally positive month for the equity market, so it's not necessarily surprising, but I do think it's going to challenge it. I think you're going to see companies, like I said, almost throw everything out that they can with the anticipation that hopefully they can beat as the year goes on. But I think there's a lot more volatility ahead for us within the equity market.
One of the other counter arguments to that is that the recession has been so anticipated and so telegraphed that now you're looking at investors looking through the first half, even the first quarter of this year, and looking past to what a recovery is going to look like. Does that explain this more optimism that we've seen in the equity market?
I think the optimism that you're seeing is kind of twofold. Yes, I think a lot of the damage was done last year. You know, you had 25% decline in the equity market. That was pricing in an economic recession. It's basically where you typically see historical bear markets bottom out. Then you also take the Fed into account. So we've seen a pretty big improvement in the inflation picture. So that now has the Fed being able to slow down their rate hikes. So that's giving some optimism to the market. However, what we haven't seen is really it filtering into the actual GDP numbers, and we think we're going to see that in the first half of this year. We're seeing it from the consumer side slowing pretty quickly, so I think you're going to get the equity markets are going to have to start to price some of that weakness in, and we'll see that in the first half of this year.
Megan, have you been advising people to put money to work outside the United States? Europe's having a great run, emerging markets are having a great run. What do you think about the US, the rest of world argument?
So we have been advising to invest in the developed international markets for quite some time. When you look at it from just the valuation perspective, they're historically cheap versus the U.S. market. They don't have as much exposure to that tech-heavy indices like we do, and that's the part of the equity market that we think will continue to be challenged. There's probably been a peak in the dollar strength that should help them, and I think that from an economic standpoint, they're doing much better than was anticipated. So we've been looking at them for a while, and we would advise clients going into that developed international side of the market.
Right, so you're talking, I mean, I'm taking away Europe here. They've had quite a run, though. I mean, some of the indices are like really close to a bull market. Can you still buy at this point, or do you kind of need to hold and wait, or does EM hold more value now?
I still would stick to the developed international. I know they've had a great run, but just when you look at them over a longer term time period and comparing them to the U.S., for example, they're still very cheap compared to the U.S. So I still like the developed international. The emerging markets, there will be a time, I think, in 2023 to get more aggressive in the emerging markets. But right now, Asia specifically, still concerned about what's going on with China and how they're handling the health situation there. They are reopened. They're kind of doing away with that zero COVID policy. But remember, they didn't really do any investment in their health or infrastructure over the time that they were closed. So I think that that's a concern as we go forward. And then also keep in mind even some of the Latin American countries, those ones that benefited from the commodity rally, that can be threatened if we do slow down here in the first half of the year.
Huge week for central banks next week. Got the Fed, got the ECB, got the Bank of England. Do you think we are, as market participants, still underpricing the desire by central banks, the main central banks, to raise rates certainly further than what is priced currently?
Yeah, I believe that. I do think that the market's getting a little too optimistic of the Fed being able to kind of stop and then cut rates. I don't that rate cuts are on the horizon. There are some saying that there'll just be 2 more rate hikes. I think that will probably go further. I think they'll go through June. The inflation situation is still very dicey. I mean, we are seeing a big improvement in it, but they're walking a very fine line. They can't give that optimism to the markets. They can't give it to the economy. Because we could just turn right back around with inflation going up. So that's a concern. I don't think the markets are pricing that in. I think they're pricing in the optimism that they will be able to cut rates, and I don't see that this year, and not even in the first half of next year.
Megan, great stuff. It's going to be an interesting week, isn't it? It's going to be really fascinating. This time next week, I think we'll be a lot wiser. Well, we've got to hope so anyway. Megan Horniman of Verdence Capital. Thank you very much indeed. Okay, still ahead. He's richer than Bill Gates and Warren Buffett. And now $51 billion of market value has been wiped out from the empire of Asia's richest man. More on Gautam Adani's and the fall that we've seen, the incredible fall we've seen as a result of that short sellers report. That story next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Chevron posted disappointing fourth quarter results just days after surprising investors with a mammoth $75 billion share buyback plan. The energy giant also wrote down $1.1 billion in its overseas business. Still, Chevron's full-year profit more than doubled to a record $36.5 billion. Customers using American Express spent a record amount last quarter, and the credit card giant predicts that revenue and profit for this year will surge well above estimates. Amex has been tweaking rewards on many of its cards that helped it add millions of new cardholders last year. And it was a tough year for Anthony Scaramucci's Skybridge Capital. It lost 39% in its biggest funds after wrong way bets on cryptocurrencies and now the bankrupt FTX. That's led investors to ask the firm to return more than half of their money. And that is your latest business flash, Guy.
Rika, thank you very much indeed. It is 22 minutes, nearly 23 minutes past 7 on the West Coast. Let's go to the startup, catching up on top tech stories from the Bay Area and beyond. Silicon Valley, starting this morning. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, great stuff. We got your background fixed, which I'm very happy about. Let's kick off and talk a little bit about, to what extent is this Adani story playing in Silicon Valley? It is a massive story on the global stage. It looks like an India issue as well as a kind of single man issue, key man issue.
Yeah.
So I'm wondering how much, to what extent are people talking about it?
They're talking about it. I mean, I would say that this is what the biggest story this week, right, in the world of financial markets and business. And, you know, a part of Adani's empire is media and telecoms businesses largely located in India, right? And part of it is that Hindenburg Research, who published that short sellers report on January 24th, they're known to us in the world of technology, right? Probably the highest profile incident that they've been involved in is Nikola and its founder Trevor Milton in 2020, where they published a short report that ultimately led to Trevor Milton last year being charged with securities fraud, and found guilty of securities fraud. So it's certainly a point of discussion here in the Bay and beyond.
How much money from the Bay Area is tied up in Adani's empire? Do we know?
Well, no, we don't know, and it's hard to say, right? I think what's so shocking about this story is the drop in value, right? So the short sellers report published January 24th, and I'm just going to say, guys, that, you know, in Hindenburg's research, there's a very clear disclaimer that readers take that the findings of the report at their own risk, right? But it has resulted in volatility in global markets. They used US debt and non-Indian listed financial instruments to do the short. $51 billion now wiped out in value and $26 billion from Adani's personal wealth. So this is having ramifications.
The story to my mind, though, is this. This maybe highlights the opacity that exists in corporate culture in India. This is an Adani issue, but it's also an Indian issue. This at the point at which a lot of companies are looking to India as the alternative to China. And I'm just wondering, a lot of people are sitting there on the West Coast looking at this and thinking, I probably need to do a bit more due diligence in terms of what I'm thinking about when I think about moving assets or production or whatever it is out of China into India.
Well, okay, so venture capitalists, many of them here in the Bay Area, have a very keen interest on the Indian market and Indian startups. It's one of the more active markets behind China when you consider a single nation in that Asia and Asia Pacific region when it comes to venture capital. I just want to go back to the basics of the January 24th short sales report of Hindenburg, right? That they basically claim that Adani, the conglomerates, he himself, have a number of offshore shell entities in Mauritius, the Caribbean, the United Arab Emirates, which Hindenburg claims is being used to facilitate corruption and money laundering. That's one side of the story. The other side is that conglomerates are, family-owned conglomerates are quite mainstay in India, right? They're quite normal, and concerns around that and how they are faring financially have been brought up before. I remember Credit Sites publishing in August a report that basically said the Adani conglomerates are really over-levered. So these are known concerns, and I think these are the early stages here.
I love the reporting. Thank you very much for joining us on Bloomberg's Ed Ludlow. Coming up, getting back to the markets, you got Chevron posting disappointing fourth quarter results, but a humongo buyback. We're going to break it down. This is Bloomberg. about an hour into the U.S. trading session. Abigail Doolittle tracking the moves. I have to say, after Intel's report, when you get the big guys like Chevron getting hit, I'm surprised that we're actually up right now in tech in the overall market.
You and me both. Take a look at this on the NASDAQ 100. I mean, it's pretty incredible that we have this pop here, because I would have expected the same thing, Alex, that we would have markets down here at this point, but we are now up 0.5%. Sometimes when stocks want to go higher, they simply go higher. We also have strong results out of American Express. That's helping the likes of Visa and MasterCard, a part of the tech index. So that could be a piece of these gains as well. Now, speaking of gains, we are looking at a third up week in the year of 2023. These are the weekly moves. We can see last year there were quite a few down weeks, but this year it's all about the gains. We're looking at a gain, I believe, on the S&P 500 of close to above 6%. So a very strong start for the year. This is important because we, of course, had the Santa Claus rally. We had the first 5 days of January higher, and it now looks like we're going to have January higher. When this has happened in the past, going all the way back to the crash around the Great Depression, we have had, on average, a 20% gain for the S&P 500. So 2023 shaping up perhaps to be a good year. Maybe some folks really think that there is going to be a soft landing. Speaking of the soft landing and the Fed does have an interesting not battle, but they have a new indicator here to take into account. And this, of course, is the PCE, their preferred way of looking at inflation, at 5%, right on line on a year-over-year basis. But some folks may think that this means that they are going to pause like the Bank of Canada. Now, we have not heard anything from them saying that, but that could be another reason why we have stocks a little bit higher on the day. Not higher on the day, though. Chevron down 2%. They missed earnings estimates. Their profit dropped just a few days after announcing that $75 billion buyback. But take a look at the annual adjusted net income for 2022, $36.5 billion, estimated at roughly $29 billion in 2023, and then $27 billion thereabouts in 2024. Not so shabby and helpful for that buyback.
Yeah. This is a company that is making a lot of money, kicking out a lot of cash, and is giving a lot of it back to shareholders, much to the annoyance, of course, of the White House. Abigail, thank you very much indeed. Let's take a look at what is happening with this company, get a little deeper into the Chevron numbers. We're joined by Paul Sankey, lead analyst at Sankey Research. Paul, everybody's getting really excited that Chevron's tracking a little lower today. The high is 188. We're trading at 181. Are we getting a little over our skis on the downside here if we're kind of getting a little upset that the company missed by a small margin?
Not really, no, because one of the things that's concerning about the result is that volumes, the company's really upstream weighted compared to Exxon, for example, and volumes are down over 3% here. So that's, if you think about the present value of a stock and the sustainability of a stock, that becomes a concern. And we'll be waiting now at 11 o'clock. The management will do the conference call, and we'll hear more about the specifics of where why we're declining volumes, year over year.
Paul,
the other thing, sorry, go ahead.
I would say, but just to hit on that, why do you think? Because is it the shareholders are demanding that they produce less because they want the higher oil price, they want the buybacks, for example, or is it an issue with the upstream? You can't get the oil out, it's too expensive. Do you have an idea yet?
Well, I've been looking, we don't have the specifics yet. We're waiting for the call, but, what I will say is the Permian is growing in line with expectations. U.S. volumes are down and international volumes are down, and it doesn't seem to be Kazakhstan. It's a little bit tricky because, everything's clumped into big groups, and it's hard to parse exactly where the volume weakness is coming from. The other aspect here, as I mentioned, is that Chevron is upstream weighted. So what you've seen yesterday was really superb results from Valero, which bodes very well for Exxon. In fact, people were expecting a lot from Valero because of the Exxon guidance. And finally, Chevron doesn't guide anymore, whereas Exxon does. So this, comes a bit of a negative surprise when they come out with their earnings, because we really haven't had any guidance about what's going to happen.
Paul, why
the other
do
thing I would
I
add, which is just to add, which is very important. Just to add, which is very important. There's a real suspicion, in my mind at least, that they announced this massive $75 billion buyback as a smokescreen for the results, because if you listen to the company's guidance, the $5 to $15 billion a year buyback, which they had previously guided to, is unchanged. They're at the top end of a $15 billion per annum buyback. But essentially what they've done here is told you about their next 5 years of buyback, which I frankly think was politically a mistake, because you're bringing attention to a 5-year program with board approval that you really didn't need to. I mean, I think they're just attracting, windfall profit tax cries where there's actually no upgrade to their buyback guidance in terms of the outlook for next year.
So is this as good as it gets, do you think, Paul, for Chevron? The stock's had an incredible run. Is this as good as it gets?
No, not really, because we're bullish oil, but everybody else is too. But obviously, at the moment, we think that the group is discounting about $80 oil, which is not far off where we are essentially. Although, of course, as you know, we're now beginning to head towards $90 Brent, and we've been calling for $120 Brent by driving season, which is pretty aggressive. And having said that, everybody's more or less bullish going into driving season here. We're waiting for the Russian product export ban to kick in next week, which could tighten things up. So I think from an oil price point of view, the question is, do these stocks start discounting a higher long-term oil price if we start, for example, moving towards a sustained $100 barrel environment? And that's a big question about the economy and everything else in terms of the demand side. But the supply side, as you can see from Chevron's results, is extremely challenged. And if demand remains as high as we think it will, with 8 billion people in the world, we could well be moving into an era of $100 oil, and all of these stocks need to go up probably another 20% at least.
So, Paul, based on that sort of thesis, and then you're looking at that flat production to up 3% from Chevron, are they going to need to buy somebody? And are they going to need to buy someone to beef up that production? Citi was saying, hey, go look at the European majors.
Well, we said, why don't you merge with ConocoPhillips? That has gone over as an amusing idea with the CEO. So we'll see. I mean, I don't know. People have said that they do need to increase their inventory. There's a tremendous dependence on Kazakhstan and Australian LNG and Permian. So it's really a three-leg stool. There's one really significant major incremental new upside, which is East Mediterranean gas, which is a huge success for the story. And of course, that was an excellent acquisition they made of Noble right at the bottom in 2020. I think it's tough for them here to buy stuff just because of the price environment and the backwardation in the oil curve. But there's certainly a view that Chevron needs another major leg, maybe, to really step up in the Permian. The problem for them in the Permian is because it's not a problem at all for them, actually. They have mineral rights, so they have a structurally higher return in the Permian than other companies. So it makes Permian acquisitions basically diluted for them. The other wild card is, why don't you buy Hess? And I think they don't want to get involved with an Exxon asset effectively, so I don't think that's going to happen.
Well, it's a fair point, and a good point about how their royalties there and how they own their assets in the Permian. But then if they were to try and buy some production somewhere, if the Permian's not really there, if they already did the gas stuff with Noble, like where else would you go to do that? Is it Guyana? Is it off Brazil? Like where do you do it now?
Yeah, that's an issue, and I think it would be more Permian ultimately. That makes the most sense in many ways because, alongside Exxon, they're both so big there. I mean, I do think Exxon Pioneer kind of makes sense, but for Chevron it's a bit more tricky, as I say, because really almost everything is diluted at these valuations. And so, it is a little bit difficult to identify where you would want to go. The East Med looks like it's going to be huge over the coming 2 decades, but actually when you look at it in the context of overall Chevron, it's not that huge. I think that they're quite happy with what they've got, and obviously the $75 billion authorization, and it's simply a board authorization, does imply that they're going to shrink to grow, basically.
No, fair enough. The stock's still down, though, by 3.6%. But to be fair, it had a nice run into that buyback announcement yesterday. Hey, Paul, always good to catch up with you. Smartest guy in the street, Paul Sankey, Sankey Research, lead analyst. Thanks a lot. All right, coming up, for many, staying active in 2023 is a top New Year's resolution. Just ask Guy. And some ETFs now have the same goal. Details next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. There won't be a tax cut anytime soon in the UK. Chancellor of the Exchequer Jeremy Hunt spoke to Bloomberg TV today in an exclusive interview.
We don't have the headroom for major tax cuts, but if I was going to prioritise where I would like to see tax cuts, it would be business tax cuts. But what businesses want even more than lower taxes is stability. And inflation is a fundamental thread of instability in the economy. It's a worry for households, it stops them spending, and it puts off businesses from investing.
Hunt also pushed back against US and European plans to subsidize green industry, which threatened to divert investment from the UK. Bloomberg learned that Vladimir Putin is planning a new offensive in Ukraine. The Russian president also is preparing his country for a conflict with the US and its allies that he expects to last for years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. It's hoping to force Ukraine and its backers to agree to some kind of truce. And President Biden's chief of staff, Ron Klain, is stepping down. Klain says he'll leave the White House around the time of the State of the Union address next month. He will be replaced by Jeff Zients, a former business executive who was President Biden's COVID czar. The White House chief of staff plays a crucial role in shaping the president's agenda. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
Hi, Ritika. Thanks a lot. So the term peak passive is making a comeback yet again. And we can actually see that playing out in the ETF market. So yes, you got Vanguard, BlackRock. They obviously dominate. We did, though, get a lot of active ETFs that launched successfully last year, and they could see more momentum into this year. Eric Balchunas of Bloomberg Intelligence, the ETF guru and senior analyst, joins us now. How much more momentum can we get?
A lot, because what's going on is active was supposed to be a big thing in ETFs for about 15 years. It was always going to be the year of active, and it never really panned out. Then Cathie Wood came along and showed that active can work. She was I would call her like a moderate hit. She still only has about 2% of all active ETF assets, but I think she really broke the doors down. What also happened is a lot of big boy kind of mutual fund companies entered the ETF space. That would be JP Morgan, Capital Group, DFA in particular. This year we have Morgan Stanley. And in the latter two cases, they've got a lot of advisors, right? Morgan Stanley has $4 trillion managed by about 20,000 FAs. So there's a lot of captive assets here. Not only that, these active funds got cheaper. So whether it's DFA, JP Morgan, or Capital Group, they're all under 40 basis points. So now you can get what you used to get for 80 basis points in an active mutual fund for under 40. And for advisors, some of them do like active, and they like it in the ETF wrapper, and they like it low cost. And so really, active is finally meeting the ETF industry on its terms. Not the issuer's terms, but on the ETF market's terms. And you can see that chart. Active ETFs that command 14% of all the flows now, even though they only make up 4% of the assets. So they're punching above their weight, and that's why our big theme for this year is that yesterday's active manager stars will be the future of the ETF industry as they come over and bring a lot of their assets with them.
The reason why we moved away from active into passive was because active didn't perform. Now, the fee structure is going to be part and parcel of maybe changing that around a little bit. But Eric, are these guys going to perform?
Yeah, that's the other good news. When the Fed started hiking rates, it meant that active got better because active typically looks for good deals relative to the price, right? So it just tilts value a little, and value came back. That means active has been outperforming. So another one of our big themes is a return to fundamentals. And so active generally looks at fundamentals. And if you ask any active manager, the last 10 years when the Fed was lowering rates, they were very frustrated. It was like everything was going up without any rhyme or reason because there was so much liquidity. Well, now it's a little more normal, and it's a better environment for them. And advisors know this. And so they're like, well, look, we like active, especially in an environment like this. Now that it's lower fee, they'll have less of a hurdle to overcome. Okay, I'll buy it. And so those things are coming together, I think, to create a nice little renaissance for active.
Can AI help with active ETF picking?
So we studied AI, right, which is another form of active, I guess, and IBM Watson supercomputer launched an ETF 5 years ago. It was like an interesting experiment, and it has not done well. It's basically trailed the S&P by about half. And I looked at why. It just trades too much. It's trying to follow momentum. and it is just not that great at stock picking. I think it's trying too hard. So we wrote a note today about how too much computing power may be a bad thing. Sometimes you just got to like wait for the stocks to do their thing and not try to trade all the time and market time. And that's sort of what brought AIEQ down.
Yeah, and trading is expensive, so maybe that is another factor into the mix as well. There are going to be winners and losers here. We've talked about maybe some of the potential winners, and maybe the balance does move in favor of active, but is all active created equal when it comes to ETFs?
No, and one we studied that was exactly how you should not enter the ETF market is the famous Fidelity Magellan. They launched an ETF 2 years ago based on, anybody over the age of 40 remembers, this fund was like the biggest deal. It was the biggest mutual fund in the 80s and 90s, run by Peter Lynch. The ETF, nobody bought it, and it's got 40 million. It's arguably a flop. One, it's too expensive at 59 basis points. Two, Fidelity did nothing to help it with assets. And three, it's in a non-transparent wrapper. Investors just don't like that. So the ones that are filed and were launched into this non-transparent, they haven't really gotten any assets. Transparent active does work. So one of our other notes that we're coming out with next week is that the active non-transparents are probably going to be extinct in 2 or 3 years. I think it's all going to go transparent, and I think Fidelity Magellan is a good example of how not to enter the ETF market. So despite the amazing brand name it had, it just didn't get any assets.
Yep. Eric, great stuff. Thank you very much indeed. That was really smart. Eric Balchunas of Bloomberg Intelligence. Thank you. Active is the way forward. I'd like to point out, maybe a little hint that maybe I'm not active enough from Alex Steele just a few moments ago. There's no basis for that. Absolutely none whatsoever. Just gonna say it.
No, totally. Yeah, I know walking up hills are hard. I get it. Maybe when you're here next week, we can have like a somehow competition.
Yeah, that's going to happen. ETF IQ is probably a show that we should be watching. Anyway, all about active. Let's talk about what we're going to talk about next. Chile holding up its interest rates at 11.25%. Not sure how this would work. Some sort of active competition between Alex Steele and me. Anyway, our interview with Chile's central bank governor next. This is Bloomberg. Emerging markets have been a huge feature of the landscape so far this year, so let's focus on Chile. The central bank there keeping its benchmark interest rate unchanged. 11.25% is the level. That is, of course, the highest level in over 2 decades. Inflation in the country, 12.8%. Daybreak Asia co-anchor Sherry Ann sitting down exclusively with the governor of Chile's central bank.
Básicamente lo que nosotros hoy día...
Our decision to maintain rates brings a forward bias. What it shows is the central bank is waiting to have enough information to see that there is a convergence of inflation towards the target of 3% within 2 years.
How should we interpret the fact that the language in the statement around inflation didn't change at all?
It means that we maintain that bias, and as long as we do not have greater clarity regarding the fact that this convergence is actually taking place, the monetary policy rate will be maintained. We have extraordinarily high inflation, and therefore it is important to have that prior diagnosis before changing the bias in policy. We see this change in the evolution of China, which is important for the price of copper. There was a movement in raw materials, but in the case of copper, we have had a significant increase. This change in the COVID-0 policy has generated a change in perspectives. What this has produced for us is an appreciation of our currency, a significant appreciation in recent times that we must evaluate carefully in light of the macroeconomic scenario in the next monetary policy report.
How is rising copper prices affecting the economy and inflation?
An increase in copper prices means more dollars in our country and therefore an appreciation. And that in the short term has certain downward forces on inflation. It has short-term effects on the downside, but the long-term effects could be the opposite. So we have to analyze in the context of what the macroeconomic conditions are in each moment, and therefore how much the impact is in the short term and in the medium term. Let's not forget that our inflation target is 2 years away. It is not in the short term.
Sherry An joins us now from Santiago, Chile. Wonderful interview, Sherry. Thank you so much for bringing it to us. That was unequivocally hawkish. What's been the market reaction to this?
Yeah, we have seen, as those comments were released, the Chilean peso gained ground and reversed earlier losses. Of course, we have broader strength in the dollar that's pressuring emerging market currencies, but we continue to see Chile swap rates increasing today because really this surprised markets going into this conversation, going into the central bank rate decision. Economists, analysts were expecting the first cut to come in April. Some were expecting even yesterday that the Chilean central bank would be the first one here in Latin America to cut rates. Well, that doesn't seem to be the case anymore, with Governor Costa really emphasizing how extremely high inflation is. A lot of the market calls, including JP Morgan, has said that the reason that Chile is overweight for them is because they expected the fastest easing cycle to happen here in Chile.
Sherry, there's been a lot of talk over the last few weeks about a common currency in the region. Did the governor have a view on that? A lot of people have been pouring cold water on the idea, including over the last few days, Larry Summers.
Calling it highly problematic, not to mention if you listen to Olivier Blanchard calling this insane. But the idea has been floated so many times over the past few decades because it could really help regional integration, not to mention, of course, regional growth and the trade side as well. But we heard this from the Brazil and Argentina presidents that they want to renew those discussions. Governor Costa thinks that this is difficult in Latin America because it's a different scenario where you have different inflations, monetary policies. So she also thinks it will be very challenging.
Really fascinating interview, Sherry. Really worth paying attention to. Thank you so much for bringing it to us. Sherry An, Daybreak Asia co-anchor, joining us from Chile. Let's talk about European markets coming towards the end of the day. We're absolutely unchanged, as you can see, on the Stock 600. It is a day, once again, of individual stocks. Score CEO is stepping down. That stock being punished as a result of that. Hennes & Mauritz, look at that, down by 4.27%. So single stocks really driving what is happening here. Kiran Ganesh, UBS Global Wealth Management multi-strategist, joining us next to discuss. This is Bloomberg.